So we talked a lot about executing trading strategies. Now it's very important that you document this so then you know exactly what worked and what didn't, so that way you can tweak your strategy, because these slight tweaks, if it earns you an extra percentage over the course of a year, imagine that compounded for decades, right? It really does have a material impact, tweaking your strategy, making it perfect to fit your lifestyle. Again, you don't need to go overboard. You don't need to tweak every single thing, but kind of, oh, should I be selling 20 deltas or 15 deltas consistently, right? It's kind of figuring out what you like, what you don't like, how much time commitment it is, and it's all about documenting it so you can create the best possible outcomes for the long term. So let's talk about a recap of our trading strategy and how you can execute this. Let's jump in. So this is just a recap video. So some assumptions that we have here are you have a $100,000 portfolio. Each contract you want to trade is 25K. So this means you can do 4 contracts. So if you want to go the covered strangle route, is probably what I'd recommend since you have access to 4 contracts. We'd start with selling a cash secured put. All right, now what do we sell this at? We sell it at the 20 delta and 45 days to expiration. So let's take a look at that. Right here we have QQQ. Today is June 30th. So 45 days out is around August 12th. And so we're looking at the 20 delta. So that's around this place right here, the 18.2 or 2.17. So let's say it's a 2.17. We would start by selling a put option at 255 strike. And when we sell that, we get to collect the bid, which is 4.96. So we right click, sell to open, change the contracts to 1, make sure it's QQQ, put the expiration, the strike price. When we sell at the bid. Here's the limit order, day, auto, everything's good here. Then we click sell to open. Now immediately, once this trade is actually executed, what we would do is right click, or we go to the actual contract that we have open. We click buy to close, come here, make sure everything's good. So 1 contract, put, the bid, ask, everything's good, and then limit, you would make this 50% of maximum profit. So we got it at around $5, so we'd sell it at 2.5. Good till canceled, and then we click buy to close. And after that's done, you'll get a notification, as long as that's set up, that the trade is executed. And that's pretty much all you need to do. That maybe takes 30 seconds, maybe a minute or 2 if you're doing it on your phone and logging in and all that. Should not take that much time. Awesome. And then you create a limit, good till canceled, at 50% of max profit. All right, now 2 things can happen here. If you get assigned, then you would sell a covered call. Again, you could do this based on urgency and how badly you want to own the stock, or whether you're like, hey, I got it at a good price, I actually don't want to sell call options and max out my upside potential. You can decide what delta you want to trade this at and how many days to expiration you want to trade at. If you want to hold this for the longer term, I would recommend doing the 15 delta and 45 days to expiration. So coming back here, we're already at 45 days to expiration. Let's just assume we got assigned, now we own 100 shares. Now what we would do is come down to the delta. The 15 delta is right in this range, 310, 315 range. So I'd probably pick whichever one you'd want, but I'm gonna go with the 310 right now. So you would right click, sell to open, again, change this contract, and then change the price to 2.49 day, and then you click sell to open. Now, after that trade gets executed, now you have a short call option. You have 100 shares and now you have a short call. You would right click, click buy to close, change this to 50% of the price that you sold it at. So you sold at 240, that should be about 120. Get to canceled, make sure the contracts are adjusted to 1, and then you click buy to close, and that would execute once the price gets to the certain point. Great, well now, while that's happening, since we have 3 more contracts, we've already used 1 right now, we have 3 more contracts. Now we sell another put option, again at the 20 delta, 45 days to expiration. And right after that executes again, we're gonna do a limit, good till canceled, at 50% max profit. Based on whether it gets assigned, same thing, we're gonna sell another covered call at 15 delta and 45 days to expiration. Otherwise, we go back to step number 1. We just kind of flow through this over and over again until we run out of contracts or we are able to deposit more money. And remember, these contracts, as they're closing out at 50% max profit, that means we were able to close out of the position, we got to keep our money, And now that our capital's freed up again, this gives us access to another contract. So we had 4, we used 1, and then now that we closed out of this trade, we were able to get another one. So it's just kind of recycling the same capital over and over again while still keeping a bullish outlook on the securities. Now, based on how many contracts you have and based on how frequently you want to trade, you could just set a certain day of the week. And I know we talked about this in previous videos. And let's just say it's Monday at 10 a.m. You just block off 15 minutes on your calendar, keep a recurring appointment, and you just make a trade based on whichever side of the trade you're on. Whether you already have stock and you want to sell a covered call, you can. Or if you have cash and you want to sell a cash secured put, you can. But literally it takes a very little amount of time and you can knock it out. Now, while you're doing this, make sure you document which deltas you're selling these contracts at, the number of days to expiration you're selling these at, the maximum profit you're closing these trades at, and the frequency of trades. Now, based on this, you'll have enough research and data to decide whether you should adjust your trades going forward or you're perfectly happy where you are. And I do want to remind you, this is something that I spent years trying to figure out myself. Right, and I'm just giving it to you like this, right? So many years of trial and error all in one video because options are so vague, but there's so much information. It's like, okay, what actually works, what doesn't work, what fits your lifestyle, and what involves so much time, right? So everything I'm presenting here is purely based on thousands of hours of research and actual trading, actual execution. A lot of time commitment went into the strategy to create a simple enough framework that anyone can follow, while giving them a significantly better risk-adjusted returns compared to just investing in the index fund, which again, I'm a huge fan of. I just think this can add just a little bit extra yield and income and can definitely help you retire decades early. Awesome. Well, I'll see you in the next video.